So are you ready for a complete economic meltdown due to the commercial real estate industry? Let's get into it. A record number of apartments have been built in the last 2 years, but nearly a third of them are in 2 states. That's either a gold mine for investors or a complete disaster waiting to happen. I'm Brennan, multifamily investor. Look, in the last 2 years, we're seeing something wild in the real estate industry. More apartments are being built than in any other single time in the last 50 years. Now, that's not just a headline. It's over 500,000 new units hitting the U.S. market. But what really caught my eye is nearly a third of those are going into just 2 states, Texas and Florida. If you're a renter, that sounds great, right? More options to choose from, lower rents, higher concessions, more deals. But if you're an investor or developer, this could be either a once-in-a-lifetime, decade opportunity or complete massive trap. So what's actually going on? Why are these 2 states pulling in so much development? And more importantly, what happens next? Let's break it all down. Let's go. So look, to really understand what's going on, you've got to zoom out. This construction boom isn't happening in just some weird vacuum. It's colliding with some of the biggest economic headwinds commercial real estate has ever faced in many years. So let's start with the money. Back in 2022, if you remember in March, the interest rates began to go crazy. Financing of big apartment projects, it wasn't easy, but it was very doable. Today, construction debt is running at 7, 8, sometimes 10%. Lenders are nervous, banks are cautious, and every deal now has to thread a needle between cost, timing, and a lot of risk. And at the same time, costs to build have gone up across the board as well. Materials, labor, insurance, permits. So developers are fighting the 2 fronts. Their borrowing costs, right? Capital's higher, and the projects are more expensive to finish. That's dangerous. It's a dangerous mix when you're working on thin margins and tight deadlines. And then there's the timing. Apartment developments are slow-moving ships. Most of the projects hitting the market now, they broke ground a couple years ago when rents were also soaring and the market looked bulletproof. But now in cities such as Austin, Raleigh, North Carolina, Nashville, and others, we're seeing signs of saturation. Concessions are back, vacancies are climbing, and this easy money area of doing this is long gone. So what happens when all this new supply crashes into the market that's already softening? For renters, awesome. There's more options, better deals, right? But for investors and developers, this could be part of the cycle where projects stop penciling out, where the equity gets all wiped out, and where banks quietly become the new owners. And this is where the real cracks start to show up, inside the banks and in financing behind these deals. You see, most apartment syndicators, even us, myself, we weren't planning on holding floating rate construction debt forever. The plan was simple: build or renovate, lease up, stabilize, and then refinance these into longer-term fixed-rate debt. But that model only works if rents rise, vacancies are stable, and interest rates are also friendly as well. In 2022, that ended. None of that happened. So now you got hundreds, if not thousands of apartment deals that looked great on paper in, say, 2021, 2022, suddenly looking like a ticking time bomb now here in 2025 and beyond. The refi window that they were counting on is long gone. Cash flow that was supposed to cover the debt vanished. And the construction loans, they're coming due. All these projects struggle to stabilize. Developers are squeezed. Some are trying to inject more capital, cash in. Others are quietly walking away, and behind the scenes, banks are getting nervous because these aren't tiny, say, mom and pop deals. These are $40, $60, $100 million assets with loans that are either on the watch list currently or already in special servicing. And the truth, some of these deals are already going back to the banks. You will not see this in the headlines yet, but this is a quiet 2008 through 2010. But insiders know there's Class A buildings right now that can't even hit 90% occupancy, can't cover their debt service, and are just sitting there. They're bleeding. And more of them start returning to the lenders. We're going to see some of these real pain multifamily deals come out in the space, and it's already happening. So what does this all mean if you're an investor or just someone watching this market? It means we're at a tipping point. We're moving from a boom to a balance and then potentially even into a bust in certain pockets. Markets like Texas, the Sunbelt states, Arizona, and Florida, they've been red hot for many years and they have tons of growth still coming. The problem is they've been oversupplied in the short term. They're facing too much supply and chasing too few tenants in the short term. Meanwhile, developers are trapped between expensive debt costs, slowing rent growth or declining, and impatient lenders. But here's the thing. Some smart, patient investors, this phase of the cycle is where the real deals happen. Because while new developments struggle to stabilize, slightly older buildings, the ones that maybe were finished a couple years ago, they're getting hit as well. They're competing with flashier new development projects offering months of free rent, and in some cases, they're losing tenants and cash flow fast. And that is the window. Finished projects, finished projects, real buildings that are already operating, but they're under massive stress. No construction risk to build, just short-term pain to get to the market where it's going to start to improve in a little bit of time. They're still desirable, just temporarily overbuilt. So if you're watching from the sidelines, this is your time to study the markets, track the migration patterns, watch rent trends, look for concessions, because sometime soon those Class A properties that couldn't refi, couldn't lease up, couldn't cover the debt, they're going to hit the market or they're going back to the banks. And when they do, someone's going to get a smoking deal. We're already looking at them. So just make sure it's not the developer holding the bag or the bank trying to unload it. Let it be you. So what do I mean by this? If you went back to kind of when a lot of these kind of Burr method deals were done on variable rate interest rates back in 2021, 2019, 2020, all the way back to 2018 and so forth, all the way up until about 2022. Then the interest rates started to go up. As we all know, they went up 11 times in 9 months, faster than anybody's ever seen in history. We knew they were going to go up too, just not like that. I don't think anybody did. And so if you were in the middle of a variable rate interest rate, okay, so let's take, for example, on my screen, let's take a deal, a $2 million apartment. We'll keep it reasonable. Go in, you do $300,000 in renovation. It's a variable rate interest rate during the term of the renovations, which is what a lot of these things were done on because the rates were so low and so attractive and all the elements were in place to where you could move through that pretty quickly, refinance the property within 18 to 24 months into fixed rate debt once the reno was done. So that's what was happening. You'd have these buildings that needed reno. They would go through, get renovated, then they would go to stabilize at the new rents that went up after the renovations were done, and then refinance that property into fixed rate debt. So let's say you were sitting at something that had, you went in and you say you had like 9% interest rate over here. And then by the time you got done, you could refinance it into 4.5 to say 5% interest rate. That's awesome. People were doing it left and right and sometimes less than that. But that party is sailed. And now you can't get those types of rates. So things have changed. So now that same thing that comes through that process, you have a couple options with it. Because now you have this building that obviously valuations are falling too because rents have dropped, vacancies have gone up, delinquencies have increased, expenses have gone up. So that net operating income that establishes your value for these buildings, it may not even be worth this 3.6 anymore. I mean, heck, it's possible it's worth what you bought it for, or in some cases less. But that's the truth of the matter right now in certain markets. Now, the only time you lose in real estate is if you're forced to sell a property when you don't want to. Because you could take any 10-year window and look at that time frame, especially apartment buildings, it's going to double within that 10-year window. The problem is you got to be able to have the staying power to get through the tough markets. Depending on your debt, that's usually the time you lose it. And I can speak from personal experience on some of these deals that we've had. So that you're going to have three options. That deal is going to get discounted and sold if it can't get refinanced. Discounted and sold at a massive deal where you can pick it up. It's going to get modified somehow, possible, and or it's going back to the bank, of which it will come to market too. So 2/3 chance there's an awesome opportunity in there. So how do you get those? You got to go direct to the brokers and sometimes to the asset managers inside the banks. But you got to go direct to the brokers and get behind the scenes to the pre-market deals that may be hitting the market. Okay. And you got to stay aware of what's going on. There's a lot of stress hitting the marketplace and you got to be aware of that. I mean, just to give you some personal experience with this, and we're going through it right now, thankfully only one, but I'm going to give you two case scenarios. So back in 2022, we had a 210 unit, $32 million deal that we went into escrow on in 2022, right as interest rates started to go up. During the course of the escrow, I think the interest rates went up 5 times. I'm not kidding. We finally had to make a very difficult decision because our investor group had about $800,000 hard at that point, a lot of money. And we could have put a square peg in a round hole and force-fed that deal to close. In doing so, we would have risked not only the $800,000 we had in, but also $12 million of investor money. I did not have the conscience. I couldn't do that. As a syndicator, investor, responsible person, I said, no. I slept on it. I literally went round and round and round. I said, I can't honestly put myself and our investors in that situation, knowing darn well there's a 50-50 shot the keys are going back to the bank. Wouldn't do it. And that was my decision, along with our partners. And I made the call. Walked away from $800,000. Best, most difficult decision I have ever made in my business life. Because of the way we handled it, all of those investors came over to another deal that we found off market that is an absolute smoking home run. And we're all going to make a gob of money on it. But I had to take it in the shorts. And because the investors saw how we handled that, right, and put their money, our money, everybody's money as though it was ours right out front, how we would handle that and have integrity and courage. That's what made that happen, right? Not easy to do. We could not afford to lose that money, but we did, and we made it happen. So that's that case study. Another case study right now is a great opportunity deal that we have in San Antonio, 121 units. Bought it at the end of 2021. Good property, good location, renovated it, business plan, timelines, everything great. Because of interest rates starting to go crazy in 2022, I knew we had to get that thing renovated and completed and refinanced before it got out of control and we ran out of money. I ended up moving out to the property from California to Texas to live on site, to speed up the renovations, to get the rents up, to get tenants in there to lease up to where we could get into fixed rate financing with Fannie Mae. We had to do it. And then it ended up being a cash in refinance of $2 million extra into the deal. That's all great. Biggest challenge is then the markets changed. So we did everything right that we could do and then some, but I can't control the markets. So as I was mentioning through in this video, now what's happened in Texas? Supply has increased in the Class A new construction. It's caused downward pressure even on our Class B buildings. So now tenants that we would otherwise normally get, they're moving up because those deals are cheaper now. They can actually afford the Class A building. So now we're left with kind of some scrummy, setups in the tenant situation. So now we have higher delinquencies, right? More evictions, higher vacancies, cash flows hit, things are challenged. It's a holding game. It is a holding game because it will eventually pay out and pay off. Thank goodness we got into fixed rate debt because that's been the saving grace. Had we not done that, we would not even be having a fighting chance right now. Thankfully, it's only one of our deals. Every single one of the deals in our portfolio, good. Fixed rate debt, we're locked and loaded. We've made money and investors make money. This one's struggling and it's frustrating. It's frustrating because we're trying and doing everything we can, but I cannot fight the market. We have to work through the market as best we can to get to the other side of it where it will work, but it is a dogfight. It is a dogfight. And that's my personal experience with it. And knowing what I do and how we do it and get in and learn it. So if anybody's listening to this and you're on and you're watching this and you want to learn this game, listen, guys, you can make an enormous amount of money doing this. And that's why you do it, because you're learning an extremely valuable skill set that allows you to grow your family wealth. You will never lose in real estate. Okay. If you do not over leverage, you focus on cash flow as king. And then that way you don't over leverage the property. And that way you can ride through tough markets. And that's what I teach. That's what I mentor. That's what we're doing now. That's the saving grace why we've even been able to hold the property that I'm talking about, is because we have 62% leverage on it, right? We're allowed to at least pay bills and keep things moving through to get through the tough market, to get to the other side. And even then it's a dogfight. So that is how you do it. And I learned a lot from the financial crisis of 2008 and 10, where I watched my dad go through a $60 million bankruptcy because he was over leveraged and he didn't focus on cash flow and he was forced to sell things when he didn't want to. So if you want to learn this stuff, please follow me, like, subscribe, share this video with people that you know. So that way the algorithms can do their job and help out and educate more people just like you. Click some of the links in the descriptions that can help you out if you want to get into multifamily, learn it for free, get some of our downloads, anything you want, but come on in. If you want to get mentored and taught in handheld, we can help out with that too through our multifamily schooled community. Love you spending a little bit of time with us. We'll see you on the other side. Take care and happy investing.